Hi there everybody and welcome back to another stock analysis video. Today I would actually like to reanalyze and update all of you guys on the company Foot Locker. I have done this company in the past, only done one video though, and seeing that the earnings are actually coming out on Friday, tomorrow, right before market open, I figured, you know what, let's come back to this company, analyze their fundamentals, and see what kind of price we can actually put them at now, seeing that the market has fallen a significant amount. So with that said, let's get started with this analysis. Coming right into the dividend summary, Foot Locker does pay out a dividend yield, guys, and actually a pretty big one as of right now of 5.17%, which ends up being 40 cents per share for an annual payout of $1.60. Payout ratio in regards to the net income is about 12.87%, essentially 13, which is actually really good, right? However, we're going to take a look at this in regards to the cash flow, because companies use their cash flow to pay out a dividend and not so much their net income. Now, in regards to the 5-year growth rate on this dividend, this is not looking good. So just based off of this number, it's telling me that this is not so much of a pretty good dividend play, and also the fact that they've only grown this dividend one consecutive year. Now, I do remember actually pointing this exact same thing out in my previous video, and I do remember going into the dividend history and seeing this exact same situation where in July of 2020, they essentially suspended that dividend for about a quarter and they reinstated it back the following quarter. However, that caused the dividend growth to reset back to 1 year. So as it stands, it's not really that good when it comes to dividend play. Now, the ex-dividend day is actually coming out on July 14th. Payout date is on July 29th, and they pay their dividends quarterly. Coming into the calculator, we got the ticker symbol of FL, market cap of $3 billion, PE of 3.52. So this is looking fairly cheap, and I think we saw this exact same thing last time as well. I don't remember what the share price was. If you guys want to take a look at that video, you guys can. But nonetheless, the share price is currently at $30.30, so this might be a pretty decent buy right now as it stands. Now, with the annual dividends per share at $1.60, as we saw, this comes out to be $155 million being paid out in dividends every single year. And if we take a look at this in regards to the 5-year average free cash flow, they're still left with $445.2 million after this dividend is paid, which comes out to be a payout ratio in regards to the cash flow of 25.85%. Coming now to the fundamentals, starting with, of course, the net income 5 years ago of $284 million to 1 year ago of $893 million. That is an increase, guys, of 214%, which is just absolutely incredible. However, if we take a look at this graph, we can see some anomalies here, which doesn't make it that good. Obviously, if we just take a look at this number, you would think it's significantly better. However, look at this. From 5 years ago to 4 years ago, it did go up to 541 million. But then from 4 to 3 years ago, it went down to 491 million. And then from 3 to 2, they went down again to 323. Now, the reason why it probably went down 2 years ago is probably because of COVID, right? Foot Locker, it's one of those companies that you probably do have to go into a store. I don't think they have a good online presence, right? However, past year, well, they essentially just pretty much tripled their profits from 2 years ago. So that's actually fairly good. However, something also to point out is that I believe Nike actually cut its ties with Foot Locker. So Nike will no longer be putting their shoes on with the Foot Locker store. And that's going to cause some issues, especially if you're a Nike's fan and you can no longer get Nike shoes in the Foot Locker store. So we might see that be an issue when it comes to their profits in the future, but time will tell. Now, coming over here to the free cash flow, the lifeblood of the company. Guys, this is the cash from operations less your capital expenditures. 5 years ago, they had $539 million to 1 year ago of $457 million. That is a decrease of 15% with an average for free cash flow of $600 million. Now, you can pretty much see this being the inverse of the net income, kind of. We see that in the net income, they did go down 2 years ago. However, in their cash flow, they went up. So what I think happened here with the free cash flow is that they just had so little capital expenditures that even though they probably made less cash from operations, they significantly cut down in their capex, which made the cash flow skyrocket. All in all, as it stands, this is not necessarily a good metric. As we can see, it is essentially flat and even decreasing. If we just ignore this COVID number from 2 years ago, we can see that from 3 years ago they have $509 million to 1 year ago of 457. So it is still a decrease even from 3 years ago to 1 year ago. Now let's take a look at the revenue. 5 years ago of $7.8 billion to 1 year ago of almost $9 billion. Guys, that is an increase of 15.11%. And this is honestly what I would wish the other two profit metrics to be looking like. However, unfortunately, only the revenue is looking like this. We do see the dip here in the COVID situation, but nonetheless, when it comes to the revenue, this is looking fairly good. Now let's take a look whether or not the company can cover their debt, which is essentially their liabilities. We're going to simulate taking the company's assets and liquidating all of them, and then using that money to pay off their liabilities and see if they can cover their liabilities and by how much money they would have left. And as you can see right here, if they were to do this, they would still be left with around $3.2 billion left. And to their credit as well, within the past 5 years, they have been positive and they've been kind of increasing this difference. Kind of. I mean, they did have an off year 3 years ago. However, they did go up 2 years ago and they did go up again 1 year ago. So that's actually fairly good. Average total assets is around $6.3 billion. Average liabilities around $3.5 billion. Doing this difference, we get around $2.8 billion. Now looking at the metric that a lot of companies tend to fail, and even major corporations tend to fail as well. However, though, when it comes to Foot Locker, they're actually doing fairly good. Guys, shares outstanding pretty much just tells you whether or not the company is diluting you as the investor. You want this number to be coming down. As you can see, it is coming down a whole lot, right? 5 years ago of 119.8 million shares to today of 97 million shares. I honestly don't know how many shares more they could buy back. Like, this is a legitimate question I have to ask myself, because in the 5 year, this is a 19% decrease. And from the previous year to the current year, we're looking at 2 years ago to 1 year ago. This is still a decrease of 6.37%, which is massive. So I'm actually going to show you guys what I mean by I don't know how much they'll be able to buy more back. In my personal opinion, they should take this cash flow instead of putting it into buyback shares, leave this as it is, and take this cash flow, essentially reinvest it back into the company to make it grow, to make new acquisitions or whatever, so be it, right? But just do something else than buying back shares, because that's apparently what they're doing with the cash flow that they have left after that dividend is paid. And lastly, looking at the cash equivalents, and we have to look at this because this is what's going to show us how we can actually adjust the price for debt. Currently, they have around $804 million in cash equivalents with an average cash equivalents of $989 million. Now let's make some assumptions. Low, median, high. 3 different factors: revenue growth, projected share buyback, and the required rate of return. Guys, revenue growth, I like to use Seeking Alpha's growth tab and make a conservative assumptions between those two numbers. If you take a look at this one, they're pretty high numbers. And as you can see, mine is significantly lower than that. Yeah, there's a reason for that, right? How much more can a shoe company essentially grow, right? We're not talking about Nike here. We're talking about essentially almost like a retailer. I don't even think Foot Locker has any brand specific shoes. I don't know. I've never shopped at Foot Locker before. So it is what it is, right? Everybody knows Nike. Everybody knows Under Armour. Everybody knows like Reebok, that kind of stuff. I don't know any brands that says Foot Locker. So I have to be fairly conservative when it comes to my revenue assumptions. Now for the projected share buyback, as I said, guys, I like to take a look at the shares outstanding graph that we just saw. And you can see here, they're fairly low as well. And I just gave you my reasoning why they're this low. And lastly, for the required rate of return, I like to keep it flat, 10% to match the S&P 500 on the best years. So let's make these assumptions. For the low one, I'm going to say a growth of 6%, projected share buyback of 1%. So you can see, guys, I'm fairly lowballing these shares buybacks because they already bought back 19% and they're essentially in the double digits when it comes to the shares outstanding. How much more could they buy back? In my personal opinion, they should probably stop this shares buyback and, I don't know, pay down their debts or increase the dividend, or I don't know, do anything else aside from buying back shares. I would, in my personal opinion, I would hope that they would grow the company a little bit more, right? Make a couple acquisitions here and there, make a couple deals, probably grow the company. I don't know, right? I really don't know what else they could do to grow a shoe retail store. But nonetheless, I'm going to put all the shares buybacks fairly low. And with all of these assumptions, this comes out to be a target share price not adjusting for debt of $130.38. For the median assumption, revenue growth of 9%, predicted share buyback of 2%, this comes out to be $145.80. And lastly, for my highest assumption, let's say a revenue growth of 12%, predicted share buyback of 3%, this comes out to be $162.68. Now let's adjust for debt, and the way we do this is the reason why we take a look at the cash equivalent. We take the cash equivalents and we add the net debt, and we add that to the market cap that the discounted free cash flow calculator comes up with. If they have more cash than debt, this number comes up. If they have more debt than cash, then this number comes down. And as you can see, it does come down for the low assumption all the way up to $111.80. For the median assumption, $127.03, and for the highest assumption, $143.72. Now, I personally like to add a margin of safety, 5, 10, and 15%. You guys can change this to whatever number you want. I personally like 5, 10, and 15%. And in doing so, I personally would like to buy this between $95 and $106.21. For the median assumption, close to $108 all the way up to $121 almost. And for the high assumption, $122 to $136.54. So as you can see, when it comes to all of these assumptions, we are fairly low at the current share price of $30.30. Now, most of you guys will probably be like, oh my god, like how could you get this difference? Like this is insane, like this is clearly wrong. Understand how discounted free cash flow works, especially my version of it. I made it so that you can actually project share buyback or share dilution into the future. Obviously, this is not 100% because just because a company buys back shares doesn't mean that the share price will go up, right? We know a lot of companies that buy back shares and their shares currently are falling. So that's kind of where I'm at with that. But this pretty much just simulates what the effects of a share buyback would do, and by default, if there are less shares out there to buy because the company has bought them all back, this automatically gives the current shares that you own a lot more value. So understand that this shares outstanding actually does make a big difference when it comes to a company's future price tag. For example, let's say that you actually believe that Foot Locker isn't going to grow at 6% and they're going to grow at like 2% within their revenue, and you say that they bought way too many shares back, right? They bought back a significant amount of shares. They're going to start issuing shares actually now. You think they're going to start issuing at 5%. Well, in doing so, we get a target share price of now $106, and if you take into account the margin of safety, we are now at $75.96 for a 15% margin of safety. So it really just depends as to what assumptions you make here, guys. This is why I have this calculator available for free. Anybody can have it. All I'm asking for in return, guys, is help me grow my channel. I would love to get to 1,000 subscribers by the end of the year. That would be amazing. Help me grow my channel. That's pretty much it. I have this calculator, the book value calculator, and a dividend tracking sheet and videos on how to set them up in my calculators playlist. You go there, there's a link in the description. You go into that link, you come up here, you make a copy and have this calculator, and you make your own assumptions when it comes to Foot Locker, when it comes to whatever company you want. Again, 3 free things for just help me grow my channel, 30 seconds of your time to hit that like, hit the subscribe, and of course, tell your friends. Now let's take a look at this company when it comes to a dividend play. Now I did say that this isn't too secure of a dividend play because they did cut it. However, let's just say that you make the average US income $68,703. If you were to put in 1 month's income into this company at the current annual dividends per share of $1.60, how much would this company be paying you at an annual, quarterly, and monthly basis? So this actually comes out to be $5,725 monthly at this average US income. And this would buy you almost 189 shares of this company. And if you take into account this dividend, this actually comes out to be $302.32 being paid out every single year. Quarterly dividends of $75.58 and monthly dividends of $25.19, which is actually fairly good across the board. So as you can see, this actually might be a pretty good play, assuming that you believe that they'll continue to increase their dividends. However, they don't have a track record of that, right? They cut it back in July of 2020 or something. I don't necessarily know why they did that, so that is already a red flag for me. I personally like consistent growth year over year for several decades if possible, right? At least minimum dividend aristocrat 25 years. So Yeah, you might get a big dividend when it comes to this one. $302 a year is nothing to laugh at. But as it stands, it's not that safe, at least for me. All in all, when it comes to Foot Locker, this is a company that I know a lot of people tend to like, but my last video that actually did fairly good. Hopefully this one does just as good. I personally, I don't see this company as too big of a deal. Like, it's sure, it has its good stuff, I guess. You know, that shares outstanding looks good. Their debts are covered essentially. So it's not that they're bad. It's just that they're underwhelming. I don't know why. I mean, yeah, they pay a dividend, and $302 is amazing a year for only $5,000. Sure, but there are a lot better companies out there with significantly better fundamentals, with better cash flows that you could put more time and energy into it, and of course resources as well. So as it stands for me, this is a pass. However, this is not financial advice, guys. You guys should do whatever you want with your money. I'm just showing you guys the raw numbers and my assumptions. That pretty much does it for this video. Like the video, like, comment, subscribe. It really does help here. Like I said, you guys can follow me on my new tech sites, BitChute and Rumble. I also have a Let's Play channel. Link is in the description, as well as those new tech sites. So if you want to follow me there, you can follow me there. With that said, peace out, and be on the lookout for the next stock analysis video.